You're watching the newsroom right here on ET Now. Markets are coming back towards the day's low. In fact, it did attempt going towards the 18,100 mark, but look at that failed attempt. It's coming back right now. So markets is clearly doing its own thing. Select banks are under pressure. Reliance is down sharply, which is weighing on the market, along with Axis Bank and a few other names. So that's the market part for you. But we have a very interesting conversation lined up for our viewers today with someone who understands macros as well as markets with equal ease. And we have Sahil Kapoor joining us now, this time, of course, from DSP. Sahil, thanks very much for your time. Great to have you. We've been reading your very interesting data points, which you keep sharing. Sahil, your latest series of notes, which is Netra, talks about that we are coming out of a long winter and the capex cycle is finally starting in India.
Right.
And you have a variety of reasons to say that. But also talk to us about how much of that is already being factored in. Do you think 22 is already, half of it is gone? Part of 23 too is now getting factored in, because earnings after this quarter's number came out, actually for 23 and 24 were trimmed at the margin.
Right. So largely, Ajay, what I see is that you're right. Part of 2023 is already factored in, and we are seeing that valuations in some sectors are stretched. But particularly when we look at this aspect which you spoke about, investments, I think it's a longer trend. Market probably is factoring in, enthusiastically, so to speak, next 2 years of earnings. But I think there is a larger runway. And when I look at this theme of investments, which covers engineering, infrastructure, industrial products, cement, many sectors which are key drivers of this theme, I think it's a theme which is more longer term in nature and probably a bit more logical this time. So just to share one or two data points with you, in the last cycle, or the only cycle which is spoken about when we speak about the capex recovery, is 2004 to 2008, and the longer cycle from 2002 to 2011. If you look very closely, that cycle, the first part of the cycle was driven by global numbers. Globally, the whole world was doing well. Commodities were on the uptick, capacities were being built, and post the GFC, post 2008 shock, capacities were built on excessive credit, and that did not play out really well. So in a sense, that cycle was a mix of global tailwinds plus some amount of domestic credit, which was not very logical in terms of capacity buildup. This cycle appears more driven by brownfield expansion, some greenfield expansion, plus a genuine pickup in both critical mass and growth rates. So if you were to give me another 30 seconds, I'll explain that by FY23, India will be doing about $1 trillion in annual gross fixed capital formation or investments to GDP, which only about 12 nations have done globally ever. That is the size that we are talking about, the critical mass. And when you look at the growth rates, since about last 5 to 6 years, because of COVID included, our growth rates of annual increase in investments have fallen to about 6.5%. And historically, in many cycles, our growth rate has been about 15-16%, generally between 14 to 16%. So I'm not saying that we are going to go back to 15% growth, or probably the super cycle of 2004 to 8, which was at 22% YOY growth. So from 6.5%, if we, let's say, go back to a projection that many economists are making today, that our nominal GDP will go back to about 10% plus. If this number also goes back to 10% plus, I think we are in for a very, very strong cycle, which can last for 5 years plus, and it has got a huge runway. So yes, your question is very important. You have to trim your expectations a bit between FY22-23, but you have to look at it from a larger cycle point of view rather than looking at it as a tactical bet.
Fair point. That's a very interesting point, because the first part of the question was actually aimed at positional guys, short-term oriented, mid-term oriented guys. And the second part was actually aimed at people who look at decadal opportunities or 5-year horizon. So the idea is that don't be off market for long. You never know, there may be a big tide and you may miss out. Sahil, talk to us about credit cycle,
Just to
because
add one more
banks have,
one, yeah,
yeah, you
just to
want to
add
say something?
Yeah, one more point just to add there. If you look at, let's say, another sector which is a very large part of this theme, which is cement. Between 2005 and 16, it had its strongest growth rate. Our production and consumption grew by about 7% CAGR. And from 2016 to at least last year, that growth was only 50 basis points. So I think we have a long runway. In many sectors, you can look at data like this, and even a slight mean reversion can create trend which can last for 5 years plus.
Very meaningful point. Uh, okay, let's talk about credit growth, Sahil, because
Right.
last 1 year, banks actually have barely performed. I'm not even considering the clutch of PSU banks who went from point A to point B as real performance. I'm talking
Right.
about private sector banks, largely NBFCs have underperformed and there's negative return. But there is some early signs, and our discussions with some of the industry participants seem to be showing that there is case to believe that, say, JFM, the January, February, March quarter, or 6 months far out, there could be, uptick in credit growth which may start coming in, because early inquiries of big capex is happening. Just today, Mr. Chaudhary has spoken to our colleagues at ET, and they are saying that in next 12 months they see big signs of capex pickup. What is your
Right.
view on credit growth, and which part of the lending universe do you think will benefit first?
Right. So two parts, Ajay. First, I think there is obviously a delayed recovery in borrowing and credit growth as a whole. I think when you look at, let's say, BSE 500, and if you look at the PAT growth that's going on, it very well aligns with how much recovery that you should see in credit growth. And I think that recovery on the corporate profitability side has already happened. Generally, it goes in line with how credit growth pans out in the future. So I'm very confident that over the next 6 months or 1 year plus, you will see these numbers at least mean revert and go back to their more normal, closer to nominal GDP growth rate numbers. And secondly, when you look at the breakup, it's driven by two things. First is that it's very visible in numbers that when we talk about, let's say, the retail lending part, it's visible in numbers that domestic earnings at the bottom of the pyramid has been hit quite badly. Lot of demand for credit has been driven by the top quartile of households, and I think the bottom quartile will come into picture once economy stabilizes, which we are already seeing the signs. I think next 6 months is a sign where recovery becomes a revival, and it becomes more stable. So I think that part will add to some demand from retail credit. I think that growth will stabilize. It will continue to be healthy. On the corporate lending side, I'm not very sure what is the timeline for, let's say, capex and demand for credits from that sector, because let's be very clear that last cycle was the credit cycle was driven exclusively, very largely by corporate credit growth. I think this time, even if we see a capex cycle, there are many other sources of capital which are getting aligned. So it's not only going to be banking credit growth. I think there is a bond market, there is a huge pipeline that the government has created. There are DFIs and lot many other avenues. So I don't think that is the only avenue to look at banking credit growth. So you will have to look at the full number, which is financial resources flowing to the commercial sector, which RBI comes out every 6 months. I think that is a number to look at. But from bank credit perspective, two things will happen. First, I think working capital loans are coming back. They will become even more stronger going ahead. Secondly, I think some amount of credit growth for corporate credit will also pick up, because you see financial health for corporates have improved a lot. But over the last 1 year, most of their, let's say, earnings or free cash flow has gone either into debt repayments, or it has been generated because they've cut costs. I think both these things are probably going to slow down a bit after 6 months, and therefore demand for credit from corporates will also go up. So largely, I see credit growth should head towards numbers like 8.5% or so in the next 6 months, and probably even stronger, which we can't predict right now, but possibly getting closer to nominal GDP numbers.
Emerging markets like India would, digest liquidity tap actually turning. it will not go off in a hurry. It will not be done suddenly. Nobody would want to disrupt the capital markets,
Right.
regulators and government, but it will start turning for sure. How do you think we'll adjust?
So I think it's a question which will get answered when it happens. Because Ajay, if you look at last 8 years, 9 years, there are very few instances where markets have been trading well, or you were seeing buoyant markets when monetary policy was either non-existent, easy monetary policy, or it was working in reverse. For example, when you look at periods like 2013 taper tantrum, we had a huge effect in all global markets, including emerging markets. Then you look at 2018, when Fed actually started to taper, reduce its balance sheet size, it had an effect on all markets globally. So we haven't really seen a phase where when you close the liquidity tab, what happens to the market. So it's an open question. I think market will get volatile. It's not, there are no two ways about it. Right now, what's happening is the excess liquidity which was created, the crutches which were given to, let's say, markets and the economy from central banks, from central governments, they are probably going away. So they're going to take away those crutches and ask the economy to run it on its own. So I think most central banks will be a little cautious in, let's say, removing the easy liquidity, the interbank liquidity surpluses, and at the same time raising rates. So I don't think they're going to do this both the things together. I think it will be a step process. So largely they will remove liquidity first, probably adjust, interest rate corridors, like our reverse repo is way too down. I think that corridor will get readjusted. But I think interest rate hikes and hawkishness can wait. I think there is still time for that to come. So largely, I think markets will get volatile. Secondly, we really don't know what kind of mechanism markets will follow when it has to function very normally without any central bank support. So short answer is that probably we'll see corrections where valuations are rich and frothy. And I think markets where the markets see growth, those sectors will generally do better than others where valuations also justify.
Sahil, you spoke about banks. You also spoke about cement as a space because capex creation, all of that. There's a big housing cycle which is also unveiling itself and unraveling itself. But should we look at the bigger picture of where the property space and related stocks, cement space and related stocks, housing finance companies and related stocks can be in 3 to 5 year period? Or because a large part of them are saying they've already run up or double, quadrupled in many cases. Has it been captured or no?
So first thing is that let's say from housing perspective, you'll see that when you look at, let's say, Nifty real estate index, you'll see that there is a huge rally. But there is a big difference between the index today and the index of 2007-8 when it peaked out. The constituents are completely different. So there is, I think, a factor to look at from a longer term perspective. But what I see is that there are more ancillary plays in real estate which will probably do better than headline numbers or headline stocks. So I think you'll have to go one level deeper to play this story. Secondly, I think housing particularly has been the biggest pain area for Indian economy to recover or actually get a very strong growth footing. Housing really has to come back. And I think we see all the ingredients. I mean, I don't want to talk about the same numbers. All of us already know it, that affordability has gone up, and housing construction probably will come back as inventory goes down. But one point is very clear, that all ingredients are ready. We probably saw a trigger in terms of COVID. So you have all the economic matrices intact, and you get a psychological trigger as well. So possibly this cycle has more legs, and it will go on for a while. Generally, also historically, we've seen that when inflation is a little higher than its long-term averages, real estate does better than most other sectors and most other asset classes. So probably that play could also come about for India. But as a whole, I think it's a larger trend which we should be confidently playing through one step lower place.
Always wonderful to chat with you. Thanks very much for your time today.
Thank you.